Hello, and welcome to this fourth day of the session, the webinar on the paper F6, the taxation Pakistani variant. So, what we are actually going to do is that we are going to continue from where we left in the yesterday's session. Uh, in the yesterday's session, what we did was we actually um, discussed the concept of in fact we completed the concept of income from business. And once we did the income from business, the next thing that we did was, after completing the income from business, what we did actually was to actually go on to the next section, that was the income from property. So we moved on to the income from property. We discussed about the income from property, and once we were done with the income from property, so what I did was I attempted one of the questions, and that question was basically on this that question was basically one of the past exam question of the paper F6 taxation Pakistani variant. So what I'm actually going to do now is that I'm going to move a bit forward and I'm going to discuss things further. So the first thing that we are going to do today is to attempt another question on this individual taxation, so that you can have a good idea about how this is actually examined. So in your handout section there are actually two questions. So then you will actually find a question which is called PQ June 2018. PQ June 2018. So let's actually open up this question so that we can actually start discussing. It's PQ June 2018. The name of the question is Ambreen. PQ June 2018. The name of the question is Ambreen. So let's actually start discussing this specific question, Ambreen. Okay, so this question, Ambreen, if I talk about the question, Ambreen, that what exactly does this question covers up? So let's try to understand. The first thing is basically it is a question which is almost a similar type of question as to what we did in the yesterday's session. It says compute Ambreen's taxable income for tax year 2018 and tax payable on filing her return of income for that year. Give reasons for the treatment of any items excluded from the taxable income. So this is what we have to do. So what I would want you people to do is to actually attempt this question, then we'll start discussing. This is included in your handout section. So try to attempt it. Okay, let's start discussing about this question. It says Amreen runs a beauty parlor in Lahore. She is also a part-time employee at APWA, giving lectures to its members on body care. So what is Amreen doing? She's actually doing this business of beauty parlor, and in addition to this, she's also conducting the lectures. So this beauty parlor is actually going to be her business, and this is actually going to be her salary. It says the following information relates to Ambreen's income and expenditure for the accounting year ended 30th June 2018. Now, so it says that income, sale of products to ordinary individual customers, tax refund received from this, additional payment received on delayed refund, and salary net of tax of 44,500 received from APWA. This is what she has actually shown. The expenditure is material consumed, purchase, so and so, so and so. The net income is given about her. Now what happens is the notes are there. The note says that the amount includes. Now we are referring to these note number 1, 2, 3. We'll refer to them later on. What are the additional information that needs to be seen? It says Ambreen has a speculation loss brought forward from the tax year 2017 amounting to 190,000. So she has a speculation loss brought forward. Remember, uh, if you have a speculation business, then what happens is if there are any speculation loss, they can be carried forward for the next 5 years. They can be carried forward for the next 5 years. In fact, they can be carried forward for the next 6 years. It says Ambreen's assets are, and again for the next 6 years, and can only be adjusted against the speculation gain. They can only be adjusted against the speculation gain. That's what can actually happen only. Now, what next is here? When we talk a bit further, it says Ambreen's business assets are all classed as equipment and had a total cost of this, against which capital allowance has been claimed till 30th June 17. Amreen obtained a car on finance lease from a scheduled bank on 1st Jan 2018. The total value of the car is rupees 3.5 million and its proportionate use has been as follows: 50% for the beauty parlor and 50% for her employment. No depreciation has been claimed on this car during the year. Amreen made payment of 250 towards the principal amount and 70,000 towards the finance charges on the car. Amreen has 2 children who are currently students at a medical college. So this is what we have, the information that we have with respect to Amreen. Now let's actually try to discuss, let's actually try to see that how exactly are we going to solve things for Amreen. So if you need to calculate the income from business, so if you need to calculate the income for Amreen, what you are actually going to do is that you're going to say computation of, the first thing that we need to do is that we need to say the computation of income from business, or the computation of taxable income. There's a computation of taxable income for Amreen for tax year 2018. For tax year 2018. Now, what next is there? So if we actually talk about it, then what actually happens is the first thing is we need to actually establish that what exactly is the business income. The first thing that we need to understand is basically the income from business. So when you talk about the business, then what happens is the first thing is you have got sales. Now, what exactly is the sales? It says sales of products to ordinary individual consumers, 2.05 million. So it's actually 2050,000. That is what the sales is. The next situation is tax refund. So the tax refund received from the income tax department for tax year 2016, it cannot be considered as an income. Furthermore, it says additional payment received on delayed tax refund. This is also not going to be taxable income. This is also not going to be taxable. It is exempt. the salary which is net of tax, we need to show it in the income from salary. We need to show it in the income from salary. Expenditure, it says material consumed in the beauty parlor. Now let's try to understand what exactly is the material. It says this includes amount costing, chemical costing 45,000, which expired and had to be destroyed. So basically a material which has not been used cannot be claimed as an expense. So basically what happens is the expense that you are going to be claiming with respect to the material, it's going to be 977,000 minus 45,000. So it is actually going to be 977,000 minus 45,000. This is what you are actually going to be claiming the expense in relation to the material. Now, what next is there? So resultingly, this expense of 977 minus 45 gives you 932,000 as an expense which needs to be claimed here. The next part of this is basically it says the rent of the beauty parlor premises number 2, 800,000. It says because the rent was below 1.5 million per year as an individual, Ambreen did not deduct any tax from the rental payments. Since this was below 1.5 million per year as an individual, Ambreen did not deduct any tax from the rental payments. Now what we need to do is that we need to see that what amount of tax actually arises on the rent. If you remember from day one, what we had is we had one of the I had shared you people the rates as per the Finance Act 2016. So if you could just review the rates as per the Finance Act 2016, so you would see this is the rate for the individuals, this is non-salaried individuals, and this is AOP, the company, then the small company. Unfortunately, over here we have not actually considered the rate for the property, but the income from property up to this 1.5 million is actually subject to tax. So what they should have done is they should have they should have deducted the taxation. So in case if any expense, the rental payment on which the tax was required to be deducted, and if you have not deducted the tax on it, if the rental payment, there was a tax required to be deducted on the rental payment, and if you have not deducted, then you cannot claim that expense. The next situation is basically it says purchase of equipment 90,000. So the purchase of equipment has to be a capital expenditure. It cannot be expensed out. Then it says wages paid to the beauty parlor staff. Now, which is actually of 1 million. So the wages paid to beauty parlor staff, which is actually of 1 million. Okay. The next situation is basically the wages paid to beauty parlor. It says wages paid to beauty parlor are based on the number of hours worked. Now, all the wages are paid in cash and the amounts paid per employee range from 15,500 to 18,000 per month. So if the employee's salaries they range from 15,500 to 18,000, that means this is the salary exceeding 15,000 paid in cash. So this is not going to be allowable then. So basically what happens is the wages which are here are also not going to be claimable expense because all of them have been paid in cash. Now it says telephone bills, including sales tax of 40,000 and income tax of 25,000 is 200,000. So basically what happens is we need to see if Amreen is registered for sales tax purposes or not. Apparently she does not seem to be registered for sales tax purposes. So when you are not registered, you can claim the sales tax as an input. So basically what is going to happen is you're going to say that the telephone bill, which is actually of 200,000, there's a 25,000 income tax. So resultingly 175,000 needs to be deducted. So basically 175,000 needs to be deducted from the telephone bill. Furthermore, we need to see that what other things are there. So if the speculation loss is there, the speculation loss can only be offset against the speculation business. It cannot be offset against any other business. It says Ambreen's business assets are all classed as equipment and a total cost of this, against which capital allowances of this had been claimed this instance. Now, what you need to do is that you need to calculate the initial allowance on equipment. Now, when we talk about the initial allowance on the equipment, so how exactly do we establish the initial allowance on the equipment? This was a new equipment of 90,000 which was purchased. So 90,000 multiplied by 25% is going to be the initial allowance on the equipment. 90,000 multiplied by 25% is going to be initial allowance on the equipment. So you get 22,500. What is it going to be? 22,500. Then you have got depreciation on equipment. So basically the original equipments that we had, it was 2.86 million. It was 2.86 million minus 1360000 plus 90,000 minus 22,500, and this whole is going to be multiplied with 15%, which is the rate of depreciation on the equipment. So if you look at it, it's 1,567,500 multiplied by 0.15. So the depreciation is going to be 235,125. Then furthermore, there was this car on finance lease from a scheduled bank. When you obtain a car on a lease from the bank, then what happens is whatever the car rental is, uh, that rental, which is basically 250,000, was paid here, plus 70,000 was paid towards finance charges on the car. So resultingly what happens is 250 plus 70 gives you 320,000 as a rental. So the rental payment was actually 320,000. Now let's see. So it was obtained on 1st January 2018. The rental payment is basically 250,000 and 50% is used for the business purposes. So what you can only claim is the car lease rentals, which is going to be 50% into 320,000. So this actually gives you 160,000. What does it give you? 160,000. So resultingly what you would have is you would have the income from business. So this is all going to be considered as your income from business. Then what happens is the salary income would be shown separately. So you would say salary from Apwa. How much is the salary from Apwa that you have actually received? So if you see the salary that you have received from Apwa is 1,005,500, and this is net of tax. The salary is always recorded on a gross basis. So it's basically 1,005,500 plus 45,500. Sorry, 44,500. So if we talk about it, so this is actually going to be 1,051,000. 1,051,000. Now let's try to establish the whole of it. So you have 525, 375 as the income from business. You have 575, 525, 375 as income from business, plus it's all going to be 1576, 375, which is actually going to be your income from business. So this is now going to be the taxable income of Miss Ambreen, which is 1576375. Is everyone okay with this? Anyone having any issues with respect to it? Yeah, anyone having any issues with respect to it? Okay, okay. So now we are actually done with the computation of income for Ambreen. Now there is one of the aspect which I actually wanted you people to understand, and that is basically how exactly are we going to compute the tax liability of Ambreen. So a very important point is that we need to know how to establish the tax liability of Ambreen. Now let's try to understand. If we talk about the computation of the tax liability, let's try to understand that what exactly the tax liability is going to be and how exactly are we going to calculate it. If I talk about the concept of tax liability, then basically what happens is when we talk about tax liability, it's computed like this. There are two types of there are two types of tax rates that are available. One of the tax rate is available for the salaried individuals, and the other tax rate is available for the non-salaried individual. Now, who is a salaried individual and who is a non-salaried individual? So what you need to do is that you need to see if Ambreen is a salaried individual as per the law, or if she is if she is a non-salaried individual. So basically, what happens is a person is a salaried individual if salary income divided by total taxable income is greater than 50%. Salary income divided by the total taxable income is greater by 50%. So basically what happens is here you see the salary income is basically 525, sorry, Salary income is 1051,000 divided by the total income 1576,375. So this actually turns out to be what? Okay, this is actually going to be 66.7%. 66.7. Okay, so it's 66.7%. So if it is 66.7% in this case, then basically this employee is going to be considered as a salaried employee, and the tax rate applicable on her are going to be this specific slab, which is the slab for the salaried individuals. So it's important that you distinguish that if a person is considered to be a salaried or non-salaried. So the person is considered to be salaried if this is how it is. So basically, the income is 1.5 million something. So the relevant slab is going to be the slab number 4. Relevant slab is going to be slab number 4. So if I talk about the slab number 4, so it says 5% of the amount exceeding 1.2 million. 5% of the amount exceeding 1.2 million. So basically 1561, 1567, 1567375 minus 1.2 million multiply by 5%. So this is actually what the tax is going to be. So this is actually going to be 18,819. 18,819. Okay. So is it fine to everybody? Is everyone okay with this? Okay, great. Now, so we are actually done with this. Another example, another question. And I think that now you people have a better and a clearer understanding of how income of an individual is computed, because you now have got a good idea about how the taxable income is computed and how things actually go about. Now let's actually move forward and let's just start discussing about one of the areas that I did not discuss in the yesterday's session, and that was basically the computation of income from property for a company. So what I did not discuss in the yesterday's session was the computation of income from property for a company. Now let's just start discussing about the income from property for a company. It is mentioned in the yesterday's slide. The slide is there in the handout section. So if you want to access the slide, it's there in the handout section. Okay. So now, what exactly is the computation of income from property for a company? So the major difference between the computation of income from property for a company and for an individual is basically, when we talk about an individual, this thing is the same. which is fair market value of the rent received or receivable. That's the same. The forfeited deposit is also same. 1/10 of unadjustable advance is also same. But over here we get the rent chargeable to tax. We get the rent chargeable to tax. Now, when we get the rent chargeable to tax, now what next is there that needs to be understood? What next needs to be there that needs to be understood and that needs to be um, that needs to be seen. Now see, first of all, there are expenses which are allowed when it comes to income from property for a company. When you compute the income from property of an individual, you're not allowed to claim any expenses. But if you compute income from property for a company, you are allowed to claim expenses. Now, what are the expenses that can be claimed? The number one point is basically the repairs to the building, the repair and maintenance. 1/5 of the rent chargeable to tax. Now, what happens is, for example, even if you have not incurred a single penny on the repair and maintenance, still you can claim the repair expense, which is up to 1/5, which is 1/5 of the rent chargeable to tax. Now, for example, if you have got this amount as 500,000, so what happens is 100,000 is going to be the repairs that you can claim without even incurring a single penny. Like for example, you might have incurred, let's say, you might have incurred an expense of repair of 30,000, but still you will recover the whole 100,000. That's what you can recover. Number two, the insurance premium paid for that building. Remember, it's insurance premium paid for the building. The one thing that I wanted to explain is that this 1/10 of the unadjustable advance is only for the building. If you get an advance against land, that is not chargeable to tax. It's only against the building which is chargeable to tax. Now what next is them? So insurance premium paid. So whatever insurance that you pay for the property, that is also claimable expense. The third thing with respect to the company is the local tax rate, etc. paid. Now what exactly do you mean by local rate, tax, etc. paid? Try to understand. There's one thing which is called income tax. There's one thing which is called income tax. You cannot claim income tax. You cannot claim income tax as an expense. You cannot claim income tax as an expense here. Yeah, but there are other things. There are other taxes. Now, what are those other taxes? Like property tax, like other local body tax imposed upon the property. So, if there are any other tax which are imposed upon the property, then such tax is actually deductible for a company only. It's not deductible for the individual. It's deductible for the company only. So I'm repeating it again. If there are any taxes that you have paid other than, if you are any taxes that you have paid other than the income tax on the property, then such taxes can also be claimed, like you pay a tax of the property, etc., etc. So that is actually going to be considered as the local tax paid, because there is local government which charges tax, then there is a provincial government that charges tax, then there is a federal government that charges tax. So the federal government charges you income tax, but these provincial government, local governments, they charge you some other taxes like property tax, etc., etc. The third thing is the ground rent. Now, a lot of people actually don't understand the concept of ground rent, that what exactly do you mean by ground rent. So basically the ground rent simply means um, that there is a land on which a building is built. So basically you are paying two rentals. If those rentals can be separated, you are paying one of the rentals for the building and one of the rental for the space for the land. So the land for the rental that is paid for the land is actually called the ground rent. The rental that is paid for the land, that is termed as ground rent. Next is basically Interest on property loan, important. Interest on property loan only. That can be, you have claimed a property, you have purchased a property, and the property is being purchased through a loan. So if that property is being purchased through a loan, and if you are a company and if you rent out that property, so what happens is you can claim the interest paid on that property against the income from property. Then collection charges up to 6% of the rent chargeable. Very important point. What is collection charges? The collection charges are, when you have got too many properties, so generally what happens is you need to go about collecting the rentals from your tenants. When you've got too many properties, you need to go about collecting the rentals from your tenants. Now, if you go about collecting the rentals from your tenants, then what actually happens is if you keep on collecting the rentals from your tenants and so and so, then what actually happens is that you incur a cost on that. So like you may have kept one or two persons for the recovery, you may have be incurring the expenditure on somebody who's operating emails, somebody who is doing calls, somebody who is visiting the premises, etc., etc. You can have several expenditures with respect to the collection of the rent. The law says that a company can claim the collection charges up to 6% of the rent chargeable. Like for example, irrespective of whatever expenses that you have incurred, only that you can claim is 6% of the rent chargeable. The only thing that you can claim is 6% of the rent chargeable. Now what next is there? The next situation is basically uh, legal fee paid. Very important. What is this legal fee paid? Well, the legal fee paid in drafting the loan, in drafting the rental agreements, that's not that's not claimable expense. What is the claimable expense against the income from property is that if you pay charges for defending the suit in a court, like for example, you have a property and somebody has claimed a wrong title to that property, then if you actually go on defending your claim, then such legal costs are going to be claimable expense. Then such legal costs are going to be claimable expense. And the last thing that you have to do is the irrecoverable rent. So since the rent receivable is taxed, that means the concept of rent taxing is the accrual basis, because even if you have not received the rent, it's still going to be taxed. So the rent is taxed on a accrual basis. So if there is a rent which has been charged to tax, if there is a rent which has been included in your income from property, and subsequently you are not able to recover that, so if subsequently you're not able to recover that, you can claim that as a expense in your income from property. But for that, you would have to demonstrate that you have taken all the measures that you would have taken to recover it, and every single effort that you did, it was not worth it, and you unfortunately are not able to recover it anymore. So then you can claim it as a irrecoverable debt against the income from property and can claim it as a deduction. It's only for the company. It's not for the individual. It's not for the individual. And Imad Ahmed is asking, can individual claim deductions? The individual cannot claim a single deduction. Individual cannot claim a single deduction. It's only a company which can claim deductions. The individual cannot, unfortunately, claim the deductions. Is it okay to everybody? Okay, so that marks the conclusion of the concept income from property. That marks the conclusion of the concept income from property. Okay, so we have concluded this specific concept also. Now what I'm actually going to do is I'm going to now move forward to another question, and I would try to actually attempt this question now. So basically the next question that I'm going to attempt is a question on a company. So we are now going to compute the taxable income of a company. Okay, in your handout section, you will find this question. The name of the question in the handout section is PQ Company December 2018. Now what you actually need to do is, in this specific question, it says Nafis Private Limited is incorporated. Nafis Private Limited is incorporated in 2001 under the Companies Ordinance 1984. It's engaged in the manufacture and sale of pesticides for use against household pests. NPL's income statement for year ended 30th June 18 is as follows. So you're being given NPL's income statement funds. Remember, whenever we are talking about a company is charged to tax on an accrual basis. A company is charged to tax on an accrual basis. Now, what exactly is the requirement to this question? It says compute the taxable income of Nafis under the appropriate heads of income, giving clear reason, explanation, so and so, so and so. So that's what you have to calculate, the taxable income of Nafis under the various heads of income. Let's try to attempt it, and we are going to start discussing at 9 p.m. Okay, so let's start discussing about this question. The name of the question is Nafis Private Limited, and we need to estimate the taxable income of Nafis Private Limited. Now let's try to understand this thing. First of all, it says that Nafis is a company incorporated in 2001 under Companies Ordinance 84, so and so, so and so. The details are given, the turnover is given, direct cost is given, gross profit is there, distribution, admin, other expense, finance cost, and then rental income from a warehouse in Vihadi, and then profit before tax, and then advance income tax paid for this, and then profit after tax. Now, the notes are given with respect to each one of them. Note 1, 2, 3, 4, etc., etc. The additional information is also given. After the additional information, it says all purchases were paid for in cash. Then the second is the addition to vehicles represent the purchase of a car for business use. Advance income tax of 200,000 was collected by manufacturer and is included in the value of the car. Now let's try to establish that how the taxable income is going to be calculated. Let's discuss. The first one of them is basically it says the profit after tax and then profit before tax. So if I talk about the income from business, what is it going to be? You'll have the profit before tax. The amount of the profit before tax for the income is basically 1.532 million or 15.32 million. That is what the profit before tax is. 15.32 million. 15.32 million. Now what next is there? The next situation is basically it's 15.32 million. Now what next is there? The next situation that we need to go about is basically we need to bring about the adjustments. Now what are the adjustments that we need to bring about? The first thing that we need to understand is basically there is a rental income which is included from a warehouse in Vihari. So what you need to do is that you need to remove the rental income from here. Now, why would you exclude the rental income from here? Because the rental income has to be included in the income from property. So I'm going to simultaneously calculate the second thing from that, which is the income from property. So the income from property is basically the rental income, and the rental income is basically 1 million here. What is the rental income? It's 1 million here. The rental income is 1 million. Now what next is there? The next situation is, this is what the rental income is. Now next situation is there are expenses which needs to be seen. So there is note number 1 which says distribution cost comprises so and so. The WIP for construction of a warehouse in Multan during June 2018. So in June 2018 you paid for the construction of warehouse in Multan. So what is actually going to happen is warehouse cost, which is deducted as 900,000. So you need to add it back. Now, why do we need to add it back? Because the warehouse is going to be a capital expenditure. The warehouse is going to be a capital expenditure. Now, let's move a bit forward. If we move a bit further, it says commission paid in cash to dealers. Tax was properly deducted. Each individual payment range between 12,000 to 15,000, which is 500,000. Now remember one of the provisions of the inadmissible deductions, and that provision of inadmissible deduction was that in case if you make any payment, and that payment is more than 10,000 rupees, in fact if you make a payment under the single account head up to 50,000 and more than 50,000 and paid in cash, then that's not allowable. Over there the income, the commission that has been paid is 500,000. So that's one of the problems. That means it exceeds 50,000. What is the second aspect to it? The second aspect to it is basically uh, the commission income is there. The second aspect to it is that all of the payments are above 10,000. All of the payments are above 10,000. So if the payments are above 10,000, you cannot claim them as an expense. You cannot claim them as an expense. So what is actually going to happen is you'll have commission paid in cash. that is going to be a disallowed, that is not going to be allowable expense. So 500,000, which is the commission paid in cash, needs to be added back. What is it? Commission paid in cash of 500,000 needs to be added back. What next is there? The next situation which is there is basically it says technical literature distributed to customers regarding safe use of pesticides manufactured by NPL. So basically, if you are distributing a technical literature, now what is this technical literature going to do? Is it actually a marketing expense or is it what? You need to consider that the technical literature which is given to the customer regarding the safe use of the pesticides, we are not being told anything. So what we can actually do is that we can think about it as an intangible. We can think about it as an intangible. If you need to think about it as an intangible, then it needs to be recognized as an asset and an amortization needs to be done. Otherwise, if you think of it as a normal expenditure, then the claim is the expense is correctly claimed. So what I'm doing is I'm actually going to add it back. I'm going to say that the technical literature is intangible. So it needs to be added up. It needs to be added up. The technical literature is going to be an intangible and it needs to be added up. Now what next is there? The next situation is cost of pesticides used in demonstration to show efficacy of the product 225,000. No evidence is available. Now when you don't have when you don't have evidence of the expenditure available, so basically that expense is disallowed because the tax authorities they tell you that you have to keep the records of whatever expenditure that you make. So if you have to keep the records of whatever expenditure you make, then if that record is not available, if that evidence is not available, then it is actually disallowed. So what you need to do is that you need to say that the cost of pesticide, you need to say the cost of pesticides, which is 225,000, is actually going to be disallowed. Is going to be disallowed. The cost of pesticides, which is 225,000, this is actually going to be disallowed. Now what next is there? If we move a bit forward, if we start discussing further, the next situation is basically um, note number 2, which is about administrative expense. It says donation to a local unapproved charity of high repute, 490,000. Remember what happens is the donations that we pay, the donations that we pay, we do not claim them as an expense. But instead, what we do is that we claim a tax credit on those donations. We claim a tax credit on those donations. Now, if we claim a tax credit on those donations, then what actually happens is um, here what you have done is you have actually made the payment. You have actually made the payment for what have you done? You have actually made the payment for an unapproved charity, irrespective of the fact it's high repute or what, but it's unapproved. So you cannot claim the expense. So what happens is you need to add up the donations which have been paid. It is 490,000 that you need to be added up. What next is there? Sales tax penalty for late payment. So remember, if it would have been a penalty pertaining to your business contract, I'm repeating it again. If it would have been a penalty pertaining to your business contract, then this penalty would have been a claimable expense. But the penalty that you have paid is not pertaining to your business expense, but instead the penalty has been paid pertaining to your, the penalty has been paid pertaining to the default or pertaining to a problem with respect to your sales tax filing. So this penalty is not a claimable expense. So the sales tax penalty is not claimable expense. This is actually 450,000. What next is there? It says depreciation of 1.25 million. So the accounting depreciation needs to be added up, because what happens is we deduct the tax depreciation. So the accounting depreciation needs to be added up. What do we need to do? The accounting depreciation needs to be added up. Now what next is there? It says running expenses on cars for the executives for business as well as their personal use as per terms of the employment agreement, 810,000. This is okay to claim as an expense. Why? Because this is running expense for the car which has been agreed as per employment, etc., etc. So anything that the employer is giving to the employee as per the agreement, that's a claimable expense for the employer, and the employee will actually be, and the benefit given to the employee would be added to his salary income, would be added to his salary income. Next, it says other expense comprise provision for estimated bad debts on the basis of historical pattern, 600,000. So I did discuss earlier also that provision for bad debt is not allowed. The provision for bad debt is not allowed. So 600,000, which is the provision for bad debt, it needs to be deducted. Next, it says the rent collection charges relating to warehouse and Rihadi, they are also not going to be allowed, because those charges are going to be claimed under the income from property. So this is 80,000. So if we talk about it, the rental income is there, and the rent collection charges, which is the actual charges, are 80,000. And basically what happens is 6% of the rent chargeable, 6% of 1 million is going to be 60,000. So whichever is lower, that needs to be claimed, because the maximum limit is the 6%. The maximum limit is 6%. So only thing you can claim is up to 6%. The rent collection charges that you can claim is only up to 6%. What next is there? It says all finance costs related to running finance facility obtained from scheduled bank, NPL has not deducted any tax on this payment. Now remember, whatever interest that you make, whatever interest that you pay, you have to deduct tax on it. Although the running finance is obtained from a scheduled bank, but you have not deducted the tax. If there is a payment on which you fail to deduct tax, that payment is disallowed. So basically what happens is the finance cost is going to be disallowed. The finance cost is going to be disallowed, which is 5 million rupees. Now, you would say it's going to be very unfair to the company. No, it's not unfair. You did not comply with the tax requirement. So now the tax authorities are not allowing you the expense. So it's going to be 5 million, which is going to be disallowed. Now, what else is there? What else is there? So basically what happens is the next thing that we need to do is that we need to actually calculate the depreciation. We need to calculate the depreciation and initial allowance on all the asset. So what I would want you people to do is take 2-3 minutes and try to attempt the depreciation and initial allowance on all the assets that the business possesses. Okay, so let's try to establish the depreciation and all that here. So we have the tax WDV at the start of the year. We have a tax WDV at the start of the year. Okay, what I'm actually going to do is I'm going to perform some calculations here. We have the tax WDV, we have the additions. So the total is there. First of all, I'm going to deduct the initial allowance. And after deducting the initial allowance, uh, the remaining item is basically the remaining WDV is going to be there. And then you will have the tax depreciation calculated again. So first of all, if we talk about it, the first thing that we need to understand is the initial allowance which needs to be claimed. There is no addition in the building. There is no addition in plant and machinery. The computers are not subject to initial. The computers, uh, in fact, the vehicles are not subject to initial allowance. The furniture and fittings are not subject to initial allowance. Now, what actually needs to happen is you need to understand. You need to try and understand few things. What is that going to be? The computers can be considered in the plant and machinery. No, the computers can be considered in the plant and machinery. So it's 500,000, 125,000 here. That is going to be what the initial allowance is going to be. Then the remaining WDV is 5 million. Here it remains 3 million. And in this case for the computers 2.5 minus 125. So it's 2375. For the vehicles, try to understand. Although the addition is 3.5, but since the vehicle is not applying for hire, the maximum addition is 2.5 million that is allowed. So this remains at 3.5 million. And the furniture and fittings, what happens is they remain at 700,000. The furniture and fittings, they remain at 700,000. Now try to understand this thing. The depreciation on the building is at 10%, gives you 500. The depreciation on the plant and machinery is at 15%. So 3,000 into 15% gives you 450,000. The depreciation on the computer equipment is at 30%. So what is 30% of 2375? 2375, 30%. 7. Okay, it's 712.5 or 713. Then you have got 3,500. The vehicles are also subject to 15%. The furniture and fittings are also subject to 15%. So it's going to be 105. Now, what exactly is the total going to be? So if we try and establish the total, it's going to be 500 plus 450 plus 712.5 plus 525 plus 105. So the total actually turns out to be 500 plus 450 plus 712.5 plus 525 plus 105. So this actually gives you 2292.5. 2292.5. So if I talk about it, depreciation and initial allowance, so it's 2292.5 plus 125 gives you 2417,500. 2417,500. So this is actually going to be 2417,500. Now what next is there? The advance income tax need to be calculated, need to be carried to the advance income tax section. That is okay. And we need to see if there is anything else. No, apparently for the income from business, there is apparently nothing. So the income from business is going to be concluded in this specific one over here. Whatever things that could be considered in the income from business are already here now. So you just need to sum it up so that you can calculate the total income from business. But when it comes to income from property, you have a collection charges and you've got a repair allowance, which is basically 1/5. So basically that includes 200,000. So if we sum up, this is actually going to be 1 million minus 60,000 minus 200,000. So this is going to be 740,000, which is the income from property, which is income from property. Now, so the income from property, since it's a company, irrespective of whether you have incurred the repair expense or not, you can claim this 1/5 of the rent chargeable as the repair expense. You can claim this 1/5 of the rent chargeable as a repair expense. Now, let's try to calculate that how much does it turn out to be. There's something which I actually want to rectify. There was an error from my side, and that was basically the finance cost of 5 million is going to be allowed. Now why? Because the tax deduction is not required on scheduled bank. The tax deduction is not required on a scheduled bank, like if you have got a bank on whom which gives you a loan. So the tax deduction is actually not required on that scheduled bank's interest. Yeah, if it would have been something other than a scheduled bank, like you would have taken the debentures or something, then you would have been required to deduct the tax on such payments. But when it comes to scheduled bank, you are not required to deduct. Now what next is there? So basically you need to actually calculate the income from business here. Okay, we also need to claim one more deduction, and that is basically the amortization. That is basically amortization that we need to deduct. Now, what amortization? We said that the technical literature uh, was basically an intangible. So you need to deduct the amortization on it. So there is going to be a 37,500 amortization on it also. So it would turn out to be 16735,000. 16735,000. So what is it going to be? 16735,000. That is what it is going to be. Now, so you've got income from business, then you've got income from property, which is 740,000. Remember, whenever we are calculating the tax liability of the company, whenever we are calculating the tax liability of the company, the income from property is not taxed separately. For an individual, it's taxed separately, but for a company, it's not taxed separately. For a company, it has to be taxed together with the other income. So what exactly are we going to do now? What exactly we are going to do now is we are going to say that the taxable income is going to be 740,000 plus 16735. It's going to be 17475,000. That is what the taxable income is going to be. Now, how do we establish the tax liability of a company? Now remember, there are various tax rates, and the tax rates available for the company are, the company is subject to a flat rate of tax. So you could see here the flat rate of tax for the company are given, and you could see the tax year 2019 is 29%. For the tax year 2018, it was actually 30%. So what is actually going to happen is you'll pay tax at 30%. You'll pay tax at 30%. So the tax is at 30%. So the tax turns out to be 5242,500. Now, a very important concept that you need to understand. And what is that important concept? The important concept is basically, as per the income tax rule, there is another concept called minimum tax. as per the income tax rule, there's another concept, and that is called minimum tax. What is minimum tax? It is at 1.25% of sales. It is at 1.25% of sales. Now, how do we establish this minimum tax? Let's try to understand. So if I talk about the sales, so what exactly are the sales going to be? Let's try to understand. The sales of this business, the sales of this business are going to be 65 million. So if I talk about 65 million, um, 65 million. So if I say 65 million into 1.25%, so what is it going to be? It's going to be 812,500. So basically whatever is the higher amount, that is the tax liability. So resultingly the tax liability of this business is going to be 5242,500. And then now what is actually going to happen is less the taxes deducted. So what are the taxes that have been deducted? If you could look at this, so you would come across this thing that there was basically the advance tax of 5 million. There was actually an advance tax of 5 million. Then there was also some payment of tax on the purchase of vehicle, which was 200,000. So there was another tax that was on purchase of vehicle, that was 200,000. So it's actually 5.2 million. That is what it is going to be. So the balance tax payable is going to be 5242,500 minus 5.2 million. So you end up having a tax liability of 42,500. You end up having a tax liability of 42,500. Okay, so is everyone okay with this? Is everyone okay with this? Okay, so that marks the conclusion of the income computation for a company. So up till now we have discussed the four heads of income, which is income from salary, income from property, income from business. In fact, these three heads. We are left with two heads, which is the capital gains and the income from other source. So that is what we are actually left with. Now what we'll do is we will take a break and we'll move forward and the next thing that we are going to discuss is going to be the income from other from the is going to be the capital gains. So this is the break right now and we are resuming at 9:50 p.m. A 15-minute break is what we are going to take. Okay, so is everyone okay till here? Okay, so the next topic that we are going to discuss is the capital gains. The next thing that we are going to discuss is basically the capital gains. Now, now the capital gain is the next section. And what exactly do you mean by capital gain? So the law states the capital gain to be the gain on disposal of. The gain on disposal of capital asset is considered to be a capital gain. The gain on disposal of capital asset is considered to be a capital gain. Now, what exactly do you mean by gain on disposal of a capital asset? So there are two important aspects to this definition. One of them is capital asset and the other one of them is the disposal. And the third important aspect is actually the gain. So now what happens is the gain in this context, the gain this in this context actually refers to the gain in this context actually refers to the consideration minus cost. The gain in this context refers to the consideration minus cost. So basically, if the consideration is 100 and the cost is, let's say, 90, you've got a gain of 10. If the consideration is 100 and the cost is, let's say, 120, then the negative 20 loss is also going to be considered as a gain, because as per the definition of the law, this is a gain. So although you'll not be charged any tax on this, but this is what the gain is. So the gain includes both, because there is a way of calculating the gain, which is the consideration received minus the cost. So basically, even if you have a loss, that's also called a gain computed on the disposal of the capital asset. So one important definition is the gain. The second important aspect is to understand the concept of capital asset. That what exactly do you mean by capital asset? So let's try to understand the concept of a capital asset. That what exactly do you mean by capital asset? It says capital asset means property of any kind held by a person, whether or not connected with a business, but does not include. So what does it say? It says the capital gain includes the property of any kind, the property of any kind uh, held by a person, whether or not connected with a business, but does not include. Now, what happens is you've got a land, you've got a building, you've got plant and machinery, you've got computers, you've got vehicles. They're all considered to be capital asset, but there are few things which need to be considered. So all of these are actually considered to be capital assets. So property of any kind. Now what do you mean by property of any kind? Movable. Property of any kind means immovable or movable both. Now let's talk. So basically what happens is it says it does not include any stock and trade consumable stores for the purpose of business because this is your inventory. Any property with respect to which a person is entitled to depreciation under section 22 or amortization under section 24. So basically if you have got a business asset on which you are claiming depreciation, on which you are claiming amortization, that asset would not fall under the definition of a capital asset. But if you have a property which is not used for the purpose of business, on which you are not claiming the depreciation, then such property is going to be considered, as a capital asset. Third thing, any movable property excluding capital assets is specified in this held for a personal use by a person or any member of the person's family dependent on the person. So it says any movable property, excluding but does not include any movable property. So all of the movable properties, like for example, vehicle, computers, etc., according to the law, they are not capital asset, but there is an exclusion. It says excluding capital assets is specified in subsection 5 of section 38, held for personal use by the person or member of the person's family. So basically any movable property is not a capital asset. That means your computer is not a capital asset. That means your vehicle is not a capital asset. That means your fixtures and fittings, they are not capital asset. Okay, so what sort of asset is that? So, but they are not capital asset. The gain on them is not considered to be the capital gain. But there are few assets which are considered to be the capital gain, and they are mentioned in capital asset, and they are mentioned in section 38 subsection 5. This is basically section 38 subsection 5. What exactly are they? These are the things. These are all example of capital asset. The law says these are movable property, but we will consider them to be the capital asset. Okay, so the law says that they are movable assets and they will be considered as a capital asset. Any other movable property like vehicle, like computer, like fixtures and fittings, they're not going to be considered in the definition of the capital asset. Let's move a bit forward. Let's start discussing further. So basically up till now, what have we done? We have discussed the concept of capital asset. What have we done? We have discussed the concept of capital asset. Now, a lot of you people would be wondering, so what is included in the capital asset? So if I could actually simplify the things, I would say that your land is a capital asset, your building is a capital asset, uh, the intangibles are capital asset, the machinery, if it is not used for the business purpose, is not a capital asset, but your investment in shares, your investment in bonds, debentures, etc., are all capital asset, and the items mentioned in section 38 subsection 5, they're all capital asset. Now they're all capital asset. Let's move a bit forward. So up till now we have discussed the concept of gain, we have discussed the concept of capital asset. Now the next thing that we need to understand is the concept of disposal. So if we talk about it, the concept of disposal is actually mentioned in section 75. Now, what exactly do you mean by disposal? Let's try to understand the concept of disposal. If I talk about the concept of disposal, the law says the disposal actually means a person who holds an asset shall be treated as having made a disposal of the asset at the time the person parts with the ownership of the asset. Parts with the ownership of the asset. So whenever you part with the ownership of the asset, that is considered to be disposal. Now, what are the ways of parting with an ownership of the asset? What are the ways of parting with an ownership of the asset? So the law says that you can either sell the asset, you can exchange it, you can transfer it, or distribute it. Now, what do you mean by sell? Sell is to sell to somebody. Exchange is you give one, you take another. Transfer is you may actually give it as a gift, you may actually give it as some other form of consideration, or distribute it. A company can actually distribute it as a dividend, or a business can actually distribute it as a dividend. So that's all distributed. Or cancelled, redeemed, relinquished, destroyed, lost, expired, or surrendered. These usually are the terminologies more relevant to the. These usually are the terminologies more relevant to the um, shares and to the debentures and etc. Things like that. So basically, this is all gonna be considered as disposal. Furthermore, it says that transmission of an asset by succession or under a will shall be also treated as disposal. What happens? What do you mean by transmission? What's the difference between transfer and transmission? The transfer actually means you're transferring. I mean, a living person is transferring. Transmission is when somebody dies. If the assets are transferred from that person's estate to another, that is considered to be transmission. That is considered to be transmission. Now, what else is there? The application of business asset to personal use. If there is a business asset, then what happens is you start using it for the personal use. That is also going to be considered as a disposal. That is also going to be considered as a disposal. Or if the asset is discarded or ceases to be used in business, it shall also be treated to have been disposed of. You discontinue using an asset, you abandon an asset, that is also going to be considered as a disposal. Also, disposal shall include the disposal of part of an asset, and at the same time it says a person shall be treated as having acquired an asset so and so at the time the person begins to own the asset anyways. The application of a personal asset to business use shall be treated as an acquisition of the asset by the owner at the time the asset is so applied. So basically what happens is, this is what the concept of disposal is. So up till now we have discussed that what is a capital gain. A capital gain is the gain on the disposal of an asset. A capital gain is a gain on the disposal of a capital asset. Is it okay to everybody? Okay. There are few questions which I'm getting from a student, Muhammad Amin. Okay, Muhammad Amin, you'll have to wait for a time because I'm going to answer your question at the end of the session, because otherwise I'm going to divert away from this capital gain topic. I'll do it later on. Now let's try to understand. So up till now, you have actually understood the concept of capital gain. That what exactly do you mean by the capital gain? So capital gain is simply the uh, gain on the disposal of a capital asset. It's a gain on the disposal of a capital asset. That is what is considered to be a capital gain. Now, so let's move a bit forward and let's start discussing few more things. So I'm going to explain to you in a very simple manner that basically what happens is whenever we talk about the capital gain, there are actually three types of capital gain that arises. The taxability of the capital gain is actually of three types. Now, what are those three types of taxability of the capital gain? One of them is basically the taxability of a capital gain under the normal section 37. There's another capital gain which is basically capital gain under section 37 capital 1A, and there is another which is section 37A. Section 37A. These are three separate items and having a separate treatment. Now, what exactly are they? Number one of them is basically this section 37 1A is about immovable property, which is basically the land or building. Section 37 1A is about the immovable property, which is the land or building. When I talk about section 37A, it's about the immovable property, which is the land or building. So for example, if you dispose of immovable property, then your gain on disposal is going to be computed and is going to be taxed in a different manner. Now, how exactly is it going to be taxed? I'll explain to you that. So now let's talk about it. So what exactly do you mean by this immovable property? So if you actually dispose of an immovable property, then the capital gain on that immovable property would be calculated as per a very specific rate, very different rate. Now, what is that rate? So I'm going to show you a few rates pertaining to this immovable property so that you can have a good idea about what those rates are actually going to be. Okay. So here it is, the capital gain on disposal of immovable property. So this is about section 37 1A. As I mentioned, section 37 capital 1A is one of the taxes where you have got this different tax rates. Now what exactly are these different tax rates? Let's try to understand them. That what exactly are going to be the various tax rates, what are going to be the tax rates for these different types of holding period. So it says for immovable property acquired on or after July 1st, other than those mentioned against serial number 1, holding period is up to 1 year, 10%. Holding period is more than 1, equal or less than 2, 7.5. Between 2 and 3 is 5. More than 3 is 0. So basically what happens is it's going to be 0 to 1, 1 to 2, 2 to 3, 3 plus. It's going to be exempt. It's for properties which are purchased after 1st July 2016. The properties which are purchased after 1st July 2016, this is what the tax rate is. So very simple. All that you have to do is that you have to calculate the capital gain on disposal of the immovable property, and that capital gain is going to be taxed at this specific rate depending upon what the holding period is. Now, what is the second type, which is section 37A, and that is called the capital gain on the disposal of securities. The capital gain on the disposal of securities. Now, let's try to understand that what exactly is the capital gain on the disposal of securities. So first of all, you need to understand the definition of securities as per section 37A. Now, what do we mean by securities? Let's try to understand. It says, for the purpose of this section, security means share of a public company. Share of a public company. So what is a public company? Whenever you have the shares of a public company, that is going to be considered as a security. That's one thing. Number two, voucher of PDCO, Modarba certificate, instrument of redeemable capital, debt securities, and derivative products. So remember, what is basically securities? Whenever you do the stock exchange trading, the shares that you dispose of on the stock exchange, that's called securities. The securities are basically the shares of the public company. Number two, all of the debentures, all the redeemable capital, all the derivative products, they're all gonna be considered as securities. So whenever you dispose of the security, whatever the gain or loss on the security is, that is basically section 37A, and it is considered to be a separate block of income. This is also separate block of income, and that one is also separate block of income. Now let's talk. So if I talk about, here you have, when it comes to the capital gain on sale of securities, here you have a table which actually tells you that what exactly are the tax rates which are applicable on the securities. What are the tax rates which are applicable on the securities? So what I would want is, I would want you people to actually go through a bit, just try to have a quick glance onto it, and then I'm going to explain them. Okay, now this is section 37A. This is section 37A. So let's try to understand. It says where holding period of a security is less than 12 months. Now, tax year 15, 16, 17, 18, and 19. Now, securities acquired before 1st July 2006, securities acquired after. There's a distinction between filer and non-filer. Now, what is a filer? What's a non-filer? Somebody who is submitting his tax return to the tax authority, he's called filer. Somebody who is not submitting his tax return is called non-filer. Somebody who is not submitting his tax return is called non-filer. So basically what happens is, the authorities, if you could see the comparison between the rates applicable for the filer and non-filer, you would see a clear difference that the filer pays a lower tax and the non-filer pays a higher tax. Filer pays lower tax, non-filer pays higher tax. So that's how the tax rate fluctuates or the tax rate changes. So again, it's actually the tax rates are easily available on any publication. You can go and access the tax card for 2018, for 2019, but you need to understand the concept, that what exactly is the concept. So concept is, if you have a security, then it's going to be taxed under section 37A, and there is going to be a different tax rate applicable on it, and the tax will depend upon the holding period, that what exactly is the holding period, the tax is going to be computed like that. Lastly, we have got the third type of capital gain, and this is actually a residual capital gain. Like for example, um, the securities are excluded, the immovable property is excluded. What are you left with now? You are left with the securities are excluded, the immovable property are excluded. You are now going to be left with what? You are now going to be left with a simple thing, and that is actually going to be the other thing. Like if you have got shares of a private company, if you have got the items under section 38 subsection 5, or if you have got anything which does not fall under security, any capital asset which does not fall under security, or any capital asset which does not fall under, or if you have got a capital asset which does not fall under the securities, or which does not fall under the immovable property, then such capital gain is going to be taxed in section 37. And when you compute the gain on section 37, remember one thing. What exactly is this? Remember one thing, what happens is that under this section 37, um, if you dispose an asset after 1 year, if you dispose an asset after 1 year, then 3/4 gain is taxable. Then 3/4 gain is taxable. If you dispose of an asset after 1 year, then 3/4 gain is taxable. What is taxable? 3/4 gain is taxable. Also, remember one thing, that if you have, let's say, gain on one asset, and if you have loss on another, then this gain or loss can be offsetted in the current year. But the exception is item under section 38 subsection 5, where the loss cannot be adjusted against any other gain. So basically, what do we mean by section 38 subsection 5? Basically what happens is, if you have got these assets, what are these assets? These are assets: painting, jewelry, rare manuscript, postage stamp, coin, medallion, antique, etc., etc. Remember, I'm repeating it again. If any of these items are, actually sold and you have a loss on them, then such loss cannot be offsetted. Such loss cannot be offset. Is it all okay? Is it all okay to everybody? Okay, great. So we have discussed the concept of capital gain also. There is another concept that I would want to explain to you people. And that is basically the concept of non-recognition rules. Now, what exactly do you mean by non-recognition rule? Try to understand this thing. The non-recognition rule says, for the purpose of this ordinance and subject to subsection 2, no gain or loss shall be taken to arise on the disposal of an asset. So these are the few situations where no gain or loss on disposal is computed. Now, between spouses under an agreement to live apart. Like for example, if there is a separation between spouses, then whatever they get from each other's wealth, that is not going to be subject to tax. There is going to be no gain computed on that, although it's disposal. Because if somebody is separating from their spouse, they're transferring it to them. So it's not going to be considered as that disposal by reason of transmission. So if somebody dies, then the wealth which is transferred to um, um, his or her legal representative, then that is also not going to be considered as gain. Gain is also not going to be calculated. The gift to a relative, compulsory acquisition, or to a company to its shareholders on liquidation, or by an AOP of its member on dissolution. So this is where the gain is not computed. Another concept that I would want you people to understand is the concept of the cost. That what exactly is the cost? So it says the cost of an asset, because when we are going to be computing the gain, this is what is important. The cost of an asset purchased by a person shall be sum of the following amounts, namely the total consideration given by the person for the asset, including fair market value of any consideration determined at the time the asset is acquired, any incidental expenditure incurred by a person in acquiring and disposing of the asset, expenditure to alter or improve the asset, expenditure to alter or improve the asset, but shall not be allowed any expenditure under clause B and C that has been fully allowed as deduction under so and so, so and so. So this is an important thing. Now, the next, another concept that you need to understand is the consideration received. Consideration received by a person on disposal of an asset shall be total amount received by the person or the fair market value, whichever is the higher, including fair market value of any consideration received in kind, where asset has been lost, destroyed, so and so, so and so. Consideration shall include any compensation, indemnity, or damages received under insurance policy, settlement, or judicial decision. If the asset is applied to personal use, then the fair market value should be considered as a consideration. Where two or more assets are disposed of in a single transaction and consideration received for each is not specified, total consideration shall be apportioned amongst the assets. These are the few things that you need to remember, that what exactly is the consideration. What exactly is the consideration? Now, we'll keep these concepts in mind when we shall be attempting one of the questions. So you have a question with you uh, under the handout section, and that's actually a practice question, capital gain tax, December 2018. It's practice question, capital gain tax, December 2018. Let's open up this question. This is under your handout section, the practice question, capital gain tax 2018. Okay, so what do you need to do? It says compute tax payable by Radha for tax year 2018 on taxable income arising from our transaction 1 to 5. Give brief explanation of your treatment in each item. Let's try to go through them, then we'll discuss. Okay, let's just start discussing. So basically, if we talk about this question, you need to understand that for every item, we need to have a proper computation. First of all, it says on 20th July, this is for tax year 2018. On 20th July 17, sold all his household furnishings used for personal use in a garage sale. The total sales proceeds on the day amounted to 400,000. Radha estimated that the cost of the furnishing sold total 250,000. So what happens is he sold all his household furnishings for use for personal use in a garage sale. Now let's try to understand this concept. The household furnishing is not a capital asset. Is not a capital asset. So basically this gain of 400,000 minus 250, which is 150,000, this is not going to be capital gain. You would say why? Because this is not a capital asset. The household furnishing is not a capital asset. The reason behind that is the capital assets do not include the movable property. The only movable property that is included is mentioned in section 38 subsection 5, and that includes the painting, jewelry, etc., etc., etc. The second one, 31st December 17, he sold his plot in Nespark housing for rupee 800,000 to his friend. The fair market value of the plot was estimated at 900 on the date of sale. He had acquired this plot on 1st December 16, so and so, so and so. Now important. So basically the plot, it's a separate block of income. It's a separate block of income. The gain is going to be based on the fair market value. So 900,000 minus 700,000 multiply by, since you are selling it between 1 and 2 year, between 1 and 2 year. So you should actually know that what is exactly going to be the tax rate applicable on it. So here we have, uh, in fact, no here. The capital gain on the disposal of a movable property between time period 1 till time period 2. So it's 7.5%. What is it? 7.5%. Similarly, on 1st January 18, he sold 40 acres of farmland for 1.5 15.525 million. Now what next is there? It says the incidental cost relating to the sale amounted to 900,000. Rather, had purchased this farmland on this for rupees 11 million. Expenses of 1.5 were incurred on this to improve drainage of the farmland to enhance its productivity. As we discussed a bit earlier that if you dispose of an asset, then basically what happens is the gain is computed as disposal proceed minus the cost, and the cost includes any incidental expenditures which are incurred in order to improve the item. So here you have got farmland which was sold on 1st Jan 18 was purchased on 1st July 17. So 1st July 17 till 1st Jan 18, this is less than 1 year. Farmland again, it's a separate block of income, less than 1 year. 15525 minus. How much is the gain going to be? It's going to be 15525 minus 11 million, which is the cost, minus 900,000, which is the incidental cost relating to sale, minus 1500, which is the cost incurred for the upgradation. So resultingly, what is actually going to happen is you will have the end result as 2125. and the tax on it is going to be 2,125,000. The tax on it is going to be 10%. Here it's basically 200,000. The tax on it is 7.5%. The tax on it is going to be 7.5%. Let's move forward. So the tax on it is going to be 15,000. The fourth item that we need to consider is on 15th March, he sold 5,000 shares in Yogi Licious Private Limited Pakistan Limited, a company on a stock exchange. So it's section 37A. It's section 37A. For 1.8 million, the shares had been purchased on 1st September on the Lahore Stock Exchange for 200%. Other costs included the following: capital value tax, brokerage fee at the time of sale, etc., etc., etc. Now let's try to understand that what was the purchase cost. It was 200 multiplied by 0.01% plus 0.3 additional cost plus 0.4 and plus 200. So how much the total cost turns out to be? Let's try to see. So this is actually going to be 200.72. How much is it going to be? 200.72. Now, so section 37A, it's again separate block of income. The listed company, it's going to be 1.8 million minus 5,000 into 200.72. And since this is being sold, you need to see that what is the time period in which it is being sold. 15th March is when it is sold. 1st September 16 was when it was acquired. So that means 1st September 16. So 1st September 17 is 1 year. So October 17, October, November 17, December 17, January 18, February 18, March 18. It's more than 18 months. It's more than 18 months. We need to see what tax rate is applicable here. So it's more than 18 months. So there is a slab of more than 12 months but less than 24 months. So it is either going to be the securities were acquired. Were they acquired before 1st July 16? No, they were acquired after 1st July 16. So it's actually going to be depending upon if it's filer or non-filer. So either 15 or 20%. So I'm just putting a 15% on it. So it's going to be 15%, another separate block of income. So it is going to be 796 400 is what the gain is going to be. And 119,460 is going to be your tax. Lastly, the last thing that we need to go about is the shares in Bright Limited, an unlisted company. So unlisted company is considered is not a public company as per the tax definition. So it's going to be a normal sale, normal gain under section 37. For 800,000 you acquired these shares for this. Now, how do we actually treat the disposal? On a FIFO basis or an average costing basis? A better approach is to go for average cost. Let's try to understand what's an average cost. It says 1 for 4 right issue taken up fully costing 40,000 per shares. So it was 4,000 shares divided by 4 multiplied by 1 multiplied by 40. So this is all going to be 40,000. Now let's try to understand. Basically what happens is sale of shares in Bright Limited. We need to see if it's being done in a proper manner. I mean, if it's sold after more than 1 year. So 1st June 18, the last purchase was in December 13. So it's more than 1 year. So the shares were being sold for 800,000 minus the cost is 90 plus 150 plus 40. 90,000 plus 150,000 plus 40,000 divided by 5,000 multiplied by 4,000 which are sold. The number of shares sold are 4,000. So resultingly what happens is whatever the gain, the 3/4 of the gain is going to be taxable. 3/4 of the gain is going to be taxable. So it is actually going to be 432,000 and it's going to be taxed under the normal taxation rate. So whatever your income is going to be, it's going to be included in that. Now, so basically that marks the conclusion of this question, which is Mr. Radha, pertaining to the capital gain. And I hope that this is clear to everybody that how we have established the capital gain on Mr. Radha. Is everyone okay with this? Is everyone okay with this? Okay, so that marks the conclusion of the capital gains and also the topics that we were supposed to cover for today. We're now left with one of the sections, and that is basically the income from other source, which we are going to consider and cover up tomorrow, inshallah. And there are a few other things which are like the other aspects, which includes the tax credits and tax losses and deductible allowances and foreign source income. So I will actually be considering them in the session tomorrow, inshallah. Now, I would appreciate feedback from you people. If you could please share your feedback of today's session and the sessions that you have attended up till now, that how far is it actually helping you serve the purpose which you actually are attending it for. Would be highly grateful if you could please share your feedback very openly and very detailed. Mohammad Adnan, recordings are available on the ACCA Pakistan channel on Vimeo. Bilal Ahmed Sheikh, thank you very much. If there is anybody else who would like to give any feedback with respect to the sessions that have been conducted till now and any further expectations that you may have for tomorrow's session. Okay, there is a question by Muhammad Amin and he's asking a question. I have a practical question related to income from salary and employment. As you said, if a person is getting fixed or a certainable remuneration and the contract was signed as an individual consultant service provider, though it comes under the definition of employment as mentioned in income tax ordinance. Will the salary slab be implemented? The answer is yes. Will it be the fee for technical service? No. Will the SRB tax be implemented? No. Now, let's try to understand this thing. Basically, what happens is the companies, what happened is you usually have people who work for you who are very good people, and they retire, they reach the age of retirement. You don't want to have them, give them the extension, because giving them the extension would mean that excessive amount of provident funds, pensions, gratuities, that's what you have to pay. So legally speaking, what people they do is that they appoint those people under the employment as a consultant. They appoint them as a consultant, pay them a remuneration, give them a proper timings on which they have to come and serve as an employment. Legally speaking, for the labor laws, that person is a consultant. For the labor laws, he is not subject to any post-employment benefit. So that's what the benefit that the employers they get if they do this type of activity. But the tax authorities, what they say is, they say that there is a judgment of a high court in which high court has actually declared such sort of commitments by the employees at the employment to be considered as employment, not as a consultant. So a lot of people used to get away with a lower slab rate, lower tax rate when they were acting as consultant or service provider. But now it's not the same. The tax rate applicable on the salary would be applicable, and you will not be considered the consultant. Hope that answers the question. Okay. So thank you very much, everybody. Thank you for your time. Thank you for attending the session. See you all tomorrow, inshallah. The topics that we are going to cover tomorrow is going to be the tax credit, the foreign source income, the losses, income from other source, etc. These are going to be the topics that we shall be covering in tomorrow's session. Thank you very much. See you all tomorrow.